All right. Thank you so much. Okay, we're going to go ahead and get started. Thank you guys for jumping on with me today. My name is Justin Carbonneau. I'm a vice president here at Validea. Over the next 30 minutes or so, it may not take us that long, but we're going to walk through the model portfolio tool specifically on the Validea website. We'll discuss to some extent the strategies that go into building these portfolios, how investors utilize these strategies in these portfolios. We'll look at some of the better performing strategies that worked last year and sort of talk about some of the, unique things that we saw with the market last year. But then more importantly, we'll talk about what's looking to work this year and what's been working so far, because there has been sort of a change and rotation in the market that we'll talk about. So really, I think the goal today is to educate those that are joining me on the types of model portfolios we run on Validea. And for those that are sort of interested in quantitative strategies like we run, you might want to consider utilizing these in your own investment process. So I know we have some active users and subscribers on with us today, but I also think we have some people that maybe are seeing the Validea website for the first time, if they haven't had a chance to sort of dive into it and play around with what's on the site. So just real quick, I wanted to just give a quick overview of sort of what Validea is and what we do here. So Validea is a independent investment research firm, and we basically build quantitative and factor-based investment strategies. Initially, when we started tracking these strategies and model portfolios, which is in 2003, we were utilizing the investment methodologies of great investors. So investors like Warren Buffett, Benjamin Graham, Peter Lynch. We were extracting those strategies from books, and we were building models off of those approaches. And over the years, we've, broadened our model lineup, and we've expanded out into academic research and other books and papers that have long-term backtests behind them that show that these strategies can be effective over time. Most of our models are looking at things like fundamentals, valuations, and momentum statistics. So that's how, we're using the underlying fundamental data to score securities and then build these model portfolios. And we'll sort of talk about that a little bit more as we go through this. So, so let's kind of, with that being said, let's sort of get into the model portfolio tool. And I'm going to focus in today on only the active stock model portfolios. On Validea, there are two sets of model portfolios. There's individual stock portfolios. So those are portfolios that hold individual equities and select individual stocks. And then there's ETF model portfolios. But for today's webinar and purpose, I'm going to focus on what we call the guru model portfolios, and that's under this portfolio tab here. The first thing I want to mention is that there are two different groups of portfolios. There's portfolios that are in our standard package, our standard subscription, and then there are portfolios that are professional portfolios, which is a higher level subscription product. All of these pro portfolios were built after 2003. So that's kind of how they're segmented out. We have the initial set of models we started running between 2003 and 2005, and then we have portfolios that were added after. And we'll also take a look at the industry and country portfolios and sector portfolios after we get through these guru strategies as well. But let's get into the model portfolio tool. So I'm just going to click on all portfolios here. Now, what this is going to do, it's going to bring you to a page that shows all the various portfolios and some high-level performance statistics on these particular portfolios. Before we get into that, let's just talk through what is going on with these drop-downs here. So we have both 10 and 20 stock model portfolios. When we built this system, we wanted to build it in such a way where kind of two things. One, that these portfolios would actually be able to be followed. So meaning, you don't want to create a model portfolio where there's 75 stocks in it, because an individual investor and even a professional investor probably isn't going to be able to follow that. So we sort of landed on, okay, with a 10 or 20 stock portfolio, you get, and there's maybe a little debate on this, but you get most of the benefits of diversification. and you're able to buy a reasonably diversified 10 or 20 stock model portfolio basket of securities. So we follow 10 and 20 stock model portfolios. And then we also offer different rebalancing frequencies or timeframes. And let me sort of explain what we're doing here. The first thing is, when you come into this page is always defaulting to the portfolio, either the 10 or 20 stock portfolio, and the rebalancing frequency that is optimal for each strategy. So what this is doing is it's showing you what is the optimal portfolio size and what is the optimal rebalancing frequency for each of these strategies. We're sort of highlighting the best performing one, but we obviously run 10 and 20 stock model portfolios, and then we run portfolios that are rebalanced monthly. So that means the portfolios are rebalanced on a 28-day cycle, quarterly, annually, and then tax efficiently. So there's four, and I'll explain what I mean by tax efficiently in a minute. But so there's 4 different portfolio rebalancing techniques that are applied to each and every model portfolio we run. Some people that really don't, there may be people with retirement accounts that really don't care about, there's no tax implications of changing monthly or quarterly. So maybe they find that the monthly portfolio rebalancing is better for them because at least within the past performance history, you can get better performance maybe by following a monthly rebalanced portfolio with some of our strategies. Other folks might want less turnover. Maybe they want less touches. So maybe an annual or even the tax efficient method might be appropriate, especially if it's taxable money that's being invested in one of the model portfolios. So when we are talking about our tax efficient method, what we're doing there is we're still following the underlying quantitative strategy, but we're only selling stocks we have a loss on that don't score high according to the model anymore, or we're only selling securities that we have a long-term gain on. So as a result, it makes deploying one of these strategies tax efficient because you're basically harvesting your losses, or you're only selling your winning positions until you hit the long-term, until you hit the 12-month mark, which is when you can kind of lock in those long-term capital gains. The last drop down is just all the various ways you can look at performance. So you can look at the model portfolio performance year to date, 10, 5, 3 trailing 1 year, trailing 6, 3 1 month, and then you can go back in history and look at the year-by-year performance. So let me do this before we get into some of the performance statistics that I wanted to highlight in this webinar. Let me show you sort of the detail behind one of the portfolios. So I'm just going to click in here. We'll use the twin momentum based on Dishon Hang. It's our best performing strategy historically. It's a momentum model, so it's clearly benefited from the strong performance out of momentum stocks over the past few years. But when you come into the detailed model portfolio page, now this is going to look and feel the same for each and every one of the portfolios that are on the site, but obviously the performance and the holdings and the changes will be different. So here you're coming into the model portfolio page, you see a performance chart, you see some high level performance data here. You have the full return history. There's that little button that says full return history. You click that, and then that'll bring you down into the portfolio's historical return since we've been tracking it. As you come down the page, you can see the current holdings in the portfolio. The default view here is the performance view, but there's also a fundamental view. So here we're just showing you the stocks, the date they were added, the score they were added, the current score based on the strategy, and then the performance of each of the positions since being added to the portfolio. As you can see, some of these stocks, were added back in 2019 even, and they haven't changed yet. So even though this portfolio is rebalanced monthly, some of these stocks have stayed in here quite a while. But you can also change it to the fundamental view, which is going to give you the fundamentals behind the stocks that you're looking at that are in the portfolio. And then you can go back at any given rebalancing date and see what was in the portfolio historically. So the reason that that may be helpful is particularly if you go back to times where there might be market stress. So, if we go back to March of 2020, which is right in the middle of the waterfall decline we had during the beginning of the pandemic, you're going to see this portfolio didn't do. I mean, you had some losers in here, but it wasn't a train wreck. Some of our other portfolios got hit really hard. Let's go back to maybe April, because maybe that didn't. Let's see what we got. So still not too bad. So a lot of these companies probably were down a lot and then came back as the market recovered. But the point is that you can use this this feature to go back and see during times of market stress how a portfolio and how certain positions would have performed, to get a sense of maybe how much risk you would have been having to deal with during that. We have our latest changes here, and then we have our current top rated stocks. What I should also mention is each time the portfolio is rebalanced, so on a monthly basis, we are sending you an email that is telling you that the model portfolios have been updated. One additional feature I'll just point out real quickly, and I'm going to come back to the portfolios, but this relates to the portfolios under My Validea. So I went research My Validea. This is like the dashboard for how users set up alerts. So there's different alerts you can set up that our system will send you, but under the My Portfolios drop option, you have the ability to add in a specific portfolio. So let's just say I wanted to follow Twin Momentum, monthly rebalancing, 10 stocks. I want to add that. So now each time that the that portfolio is rebalanced, I'm going to get an alert to notify me. This is probably a little bit more helpful if maybe you're not following strictly a monthly rebalance portfolio, because if you're doing that, you're probably going to know, okay, each month you're going to get it. But if you're doing quarterly or annually or even tax efficiently, maybe I think this alerting system might be a little bit more, useful for the investor. But I did just want to point out that that exists for folks if you don't know that that's there. Okay, so we're back on the model portfolio page. This is like the main landing page. As I mentioned, there are certain portfolios in different, the Validea Standard and the Validea Professional package. And the way that you can identify those is just through the drop down. You can kind of see these are the ones in the Standard, these are the ones in the Professional. But I wanted to just spend a couple minutes highlighting a few of the things that we're sort of seeing in the market. Some of this, and it's sort of being flushed out in the performance of some of our portfolios. And I think these are things that, we pay a lot of attention to. It's not that you're going to necessarily make it, you may not make any adjustments to your portfolio or your investment strategy because of this, but they're things to consider, and they're just different narratives that I think that have played out and are playing out that are worth highlighting. And I kind of like to use the portfolios as a way to sort of show that or demonstrate that. So what I did is I changed the drop down here to 2020. So let's think about what happened last year, which many of you know what happened. We had a massive decline at the beginning of the year. The quickest 30% decline, I believe, the stock market has ever witnessed, and then a massive recovery back up as the government stepped in, as the Fed stepped in, as sort of the developments in the vaccine sort of took hold in the fall. But one of the things that really came to the surface last year was, and this is kind of a continuation of the past few years, is that momentum strategies and growth strategies pretty much blew away most value strategies. So here are top performers. And by the way, this small cap growth investor strategy based on the Motley Fool, I believe that returned 106%. was the first model in all of our years of tracking these strategies, was our first on a calendar year basis model to return over 100% in a given year. So that was pretty crazy that you had a strategy like this one that was able to deliver 100% returns. Those basically never come around. I mean, like I said, this is the only time ever in our history on a calendar year basis that a strategy's done that. But that is one thing that's kind of amazing. But you had small cap growth investor. This is basically a kind of what it sounds like. It's a small cap growth strategy. Quantitative momentum. Momentum blew the doors off last year as well. So a lot of these technology stocks, especially in the first half of the year, were really outperforming. You had the twin momentum investor model, which is this is basically a well, let me back up. Quantitative momentum is just strictly it's a momentum based factor model that looks for stocks with high momentum and that have consistency in their momentum. Twin momentum is based on a research paper by Deshaun Hang. It combines fundamental momentum factors with price momentum. And then the growth investor model based on Marty Zweig's book, Winning on Wall Street, which is really like a earnings growth and earnings persistence type of strategy. But here at the top of the food chain last year was the growth and momentum stuff. Coming down, you had a lot of value strategies underperforming. So some of these names you're probably going to be familiar with, some of them you might not be, but David Dremen's Contrarian Investor Strategy, it's really a deep value model. Piotrowski's Book to Market, the Ken Fisher price to sales model, which we based on his book Super Stocks. So all of these strategies, we had a handful of strategies that were underperforming the market and some quite substantially here for the full year. But one of the things that's very interesting is when, and this is what we're seeing this year, and it's early, of course, we're only like 20 days into the year, but the turn in some of these value strategies actually is happening and has been happening for a little while. So here what I did is I changed it to year to date. So if you notice here, these four strategies are basically like value strategies. Some of these are up. The acquirer's multiple, which is based on Tobias Carlyle's book and work. That thing's up 25% this year, the 10 stock tax efficient model. The value composite strategy based on Jim O'Shaughnessy's What Works on Wall Street. Again, another, isolating only value stocks using a value composite, it's up 16%. And if I go back to, let's say, the past 3 months, here again, we see these value strategies making a big comeback. And so I think what this is indicating is potentially a couple things. Is we've been in a period since really 2007 where growth stocks have outperformed value stocks. There's many reasons for that. If anyone follows us on our podcast, we talk about this like every other episode. We talk about this trend of growth over value and how it's kind of opposite of what has worked over the very long term. But we're starting to, and you're seeing it here, there's potentially some, big changes on the horizon with fiscal stimulus, with potentially higher growth coming out of this, the amount of money that's been, pumped into the system, higher inflation expectations, a weaker dollar. Those things are generally kind of good things for value. And I think what you're seeing here is our strategies are reflecting a lot of that. And I think as an investor, as you think about your positioning for the next 5 to 10 years, value stocks have dramatically underperformed growth over the past 10 years. And these things do tend to come in cycles. You had in the 90s, you had, a really good run for growth stocks coming up until 1999. Then from 2000 to 2007, value stocks crushed it. So it's just, I think just pay attention to that trend and think about your positioning in your portfolio. And especially for people utilizing the Validea system, you want to kind of be maybe thinking about that a little bit more too, and sort of looking at some of the performance data and trying to understand, I think, what it means. The other thing I want to show you is our industry and country portfolios. And this is somewhat similar to the value story, although it's different because it's sectors and industries and countries. But one of the things that we know is for the last 10 years, I mean, basically what's been on top? US stocks, large cap stocks, technology stocks. Those stocks have been the ones that have been the best performers. It hasn't been the small, the value, the international. But and that is reflected if you look at like our top performing industries. You know, here we have the technology portfolio, which is the top 10 technology stocks selected using sort of a consensus-based system that we run here. That portfolio is the best performer since inception. And if you come down here, you'll notice that actually China is still in the country. Our US-based country portfolio actually hasn't done that well given the way that we select those securities relative to the S&P. But China has actually, our China portfolio, which is the top scoring Chinese ADRs, is the best performer. But that's, it's come back a lot recently. And when you switch when you go from the annual since inception to year to date, what you're going to see here again is this like flip of here are some of your value sectors, particularly energy and retail, that are up a lot on a year to date basis. And then you have, you know, China rallying a lot. You have your brick companies. You know, here's Asia. So, and again, these are just, we're not selecting the direct shares or listings on these foreign exchanges. Our country portfolios are limited to the ADRs in our universe. I think we have about 600 ADRs that are in our data set that come in, and then we build the portfolios off of those. So it is limited to the ADR universe. Just a couple things before I open it up for questions, if there is any. You know, I think depending on where you have your online brokerage account, you know, the fact that you can do, it's basically zero commissions now, and you can do fractional shares. Like we manage money for investors using the system, and we've been trading at Folio FN. Folio is a firm that has actually been doing fractional shares for a long time. They were recently acquired by Goldman Sachs, and they're getting out of the retail business. But you know, with Fidelity and Schwab and E-Trade and Interactive Brokers, so you can basically get, you know, zero, doesn't cost anything to trade. And because you can do fractional shares, you know, deploying a model like this, like any of these, is actually quite simple, because you can, the way we build and construct and track the performance of these models is we assume equal weight. So if you're following a 10 stock portfolio, that would mean 10% in each position, or if it's a 20 stock portfolio, it's a 5% weighting. So, you know, it makes, because of that fractional share ability, you can kind of get to these models. You can build these models exactly how we've kind of built them here on Validea, and it can basically not cost you anything. You can almost, you know, do it for free now. So, you know, that's a lot of the technology and development and the falling costs, I think, has made it more realistic for investors to be able to actually build these portfolios like we run, and actually make them followable, and doing it in a way that's pretty cost effective. There is, on this page, there is a user guide, and there also is a video tutorial. I think that would just bring you over to YouTube on the Validea channel. And, you know, we show you a little bit more as to what goes into the model portfolios. So I think with that, I'm going to sort of end my formal part of the presentation. If anyone has any questions for me, you can put those in the chat box, and I'll spend a couple minutes answering those for you. We used to do these webinars, so it was more of a full presentation of all of the tools on Validea, but I think we kind of want to make them a little bit shorter, a little bit more focused, and really kind of focus in on one specific tool. So today I'm obviously doing the model portfolios, you know, and you'll get notices from us from time to time of other webinars. So hopefully you guys can join in on those, and you can learn more about the other tools and research features on Validea. Well, one of the things, just as you guys think if there's any questions, is the returns of our model portfolios and the returns of the S&P 500 are price returns only. They do not include dividends, and they obviously don't include any fees. So all we're doing is we're just reporting out the model portfolio performance. But just so it's very clear, these aren't real live actual returns that are netted out with fees and things like that, and they don't include dividends. So I just want to make sure that people know that what they're actually looking at. The other thing I'll say, and this is something that it's important. Sometimes you see these portfolios and they have really good returns and they have delivered excellent returns over a very long period of time. But one of the things that we know, we always know, is that each and every one of these strategies will go through periods when they don't outperform the market. There's no strategy out there that outperforms every month, every year, whatever it is. All of these strategies will have periods that they've underperformed. And some of our value strategies have underperformed for a very long period of time. We're seeing a big reversion in that now, like I pointed out. But the point is that, these strategies aren't foolproof. What they are intended to do is give you the ability to have a investment strategy that you hopefully believe in and understand, and then giving you the ability through this model portfolio tool to actually implement, a portfolio and follow it hopefully for the long run. But it doesn't mean that the strategy is guaranteed to work. And it also doesn't mean that it won't go through periods of long periods of underperformance. It's actually a characteristic of an outperforming strategy to see periods when they don't work. Okay, yeah, this is a good question on the accuracy. So that was on, let me see here. So we also have it on the country and industry portfolios. There's a question about accuracy. So let me see. Generally, okay. That was a good observation because we don't list it on the main portfolio page. We actually do on the detailed page. But what this is showing you is what percentage. So with technology, 55.2% accuracy. So what this is basically showing you or telling you is that within this portfolio, we get 5.5 out of 10 positions correct historically. So, if we buy 10 stocks, 5.5 to 6 of them are going to appreciate on average, and 4 are going to lose money. And that's what's interesting with that is, let's go back to, I know I've seen this with the Motley Fool strategy. So here, the small cap growth investor model. So this is a really interesting thing to think about. So this is one of our better performing models. So this is the 10 stock tax efficient small cap growth investor strategy. It's basically almost, so it's almost double the market. It's had a huge run recently, as you can see here. Let's see what the past, I think, because we know it was up 100% last year. This is the model we were looking at. So if we take a 1 year, let me just get a 1 year chart here on this. So the strategy's like doubled in the past year, right? But what's amazing with this is you can get this type of outperformance, 14.6% annually, or versus 7.9% for the S&P 500, going back to 2003. But the model gets slightly less than half of the positions right. So we're only getting about 5 out of every 10 stocks we buy, we're actually appreciating in value. The other 5 are going down. But what I think that also means is that, so that's just interesting to think about. You can have a strategy that only gets 50% of the positions right, but actually doubles the market. And what that probably means is the losers it cuts and I know this by understanding the strategy, this has a relative strength component to it. So I think it kind of cuts its losses pretty quickly, because if a stock is exhibiting downward or falling momentum, it gets it out of there, and it will hold on to its winner. So that's just an interesting, that's what we mean by accuracy. So anyways, it's a long-winded answer, but that's what we mean by accuracy on those pages. So what I'll do is I'm going to email each and every one of you individually. And if you have questions for me directly, you can ask me then. And, for those of you that are users and subscribers to Validea, thank you very much. We appreciate your business. And for those that aren't, that are interested in this, what we've built here, we have a risk-free trial. We do require the credit card up front, but you can cancel within the 7-day risk-free trial. And we have a bunch of different subscription plans that you can try. So we're pretty flexible here. We're a small company. We're pretty flexible here around that stuff. So we hope to see you guys on Validea. I hope everyone has a great day, and I'll be in touch. So thank you very much.